Hey everyone, welcome back to Corporate Decoder, the place where we shine a light on what big companies are doing behind closed doors. And today we have an interesting report from Aviat Networks Inc., a company that builds wireless networking gear. Today we are diving into their quarterly report for the period ending the 26th of December 2025, a period where they are looking to continue their growth trajectory. But let's see if the numbers tell the whole story. Before we dig in, make sure you smash that like button and subscribe if you want more of these deep dives into corporate filings. Also join our Discord community linked in the description below for more real-time insights and discussions. Aviat Networks Inc. is in the business of designing, manufacturing, and selling wireless networking solutions and services to a variety of customers from mobile carriers to government agencies. They are essentially the backbone of a lot of wireless communication. Now let's get straight to the numbers straight from their income statement. For the 3 months ending the 26th of December 2025, their total revenues were just over $111 million. That is a decrease from the same period last year where they brought in almost $118.2 million. A slight dip, not terrible, but worth noting. However, when we look at the first 6 months of the year from January to December 2025, their total revenues jumped to over $218.7 million compared to just over $206.6 million in the prior year. So while one quarter saw a dip, the 6-month picture is a positive one showing growth. Breaking that down, product sales for the quarter were down slightly to $81.2 million from $82.3 million the previous year. Services revenue also saw a drop from $35.8 million to $30.2 million in the quarter. This dip in services revenue is quite significant, a nearly 16% drop. For the 6-month period, product sales actually grew by about 9% to $156.2 million, which is good news. But services revenue dipped slightly by about 1%. This shows a mixed picture where products are selling better, but services are struggling a bit. Now let's talk about gross margin, the money left after accounting for the costs of making their products and services. For the quarter, gross margin was $36.1 million, down from $40.8 million last year. This is a nearly 12% drop. The gross margin as a percentage of revenue also fell from 34.6% to 32.4%. This tells us that their costs are rising faster than their sales in this period, or they are selling lower margin products. For the 6-month period though, gross margin actually increased by a healthy 18.3% to $71.7 million. This is driven by product sales, which saw an increase in their margin percentage from 25.3% to 31.4%. Service margins, though, took a hit for the quarter, dropping from 37.7% to 30.9%. Operating expenses are always interesting. Research and development costs decreased significantly by about 37% for the quarter, down to $6.4 million from $10.2 million. Over the 6-month period, research and development expenses dropped by 34.5% to $13.5 million. This could signal that the company is streamlining its R&D efforts, or perhaps has completed major development phases and is focused on cost management. This is a definite strategy shift to watch. Selling and administrative expenses saw a slight increase of about 5.2% for the quarter, reaching $22.3 million. For the 6-month period though, these expenses decreased a tiny bit by about 1%. It seems they are trying to keep a lid on these costs. The bottom line operating income for the quarter was $7.2 million compared to $7.9 million the prior year. So a small decrease, but for the 6-month period, operating income was $12.4 million, a huge turnaround from a loss of $7.5 million in the prior year. This is a significant positive swing, suggesting improved operational efficiency or better cost control over the longer term. This leads us to net income. For the quarter, net income was $5.7 million, an increase from $4.4 million last year. That is a good sign, and for the 6-month period, net income was $5.8 million, a massive improvement from a net loss of $7.3 million in the prior year. This overall positive trend in profitability, especially in the 6-month period, is very encouraging. Looking at earnings, per S-Hair basic earnings per S-Hair for the quarter rose to 44 cents from 35 cents last year. For the 6-month period, it was 46 cents compared to a loss of 58 cents last year. Diluted earnings. Per S-Hair also followed this trend, showing a healthier profitability picture. It is important to note that the number of shares outstanding has slightly increased, which is typical with stock incentive plans, but the earnings growth has outpaced this increase. Now let's shift gears and look at the balance sheet, their financial snapshot. As of the 26th of December 2025, Aviat Networks reported total assets of over $659 million, an increase from $633 million in June 2025. That growth in assets is generally a positive indicator. Accounts receivable stand at $203 million. This represents money owed to them by customers. Unbilled receivables, which are essentially revenue recognized, but not yet invoiced, are at $90.6 million. Inventories are at $76.6 million. These numbers show a healthy flow of business and what they have on hand. On the liabilities side, current liabilities are $267 million. This includes accounts payable, which is money they owe to their suppliers, at $145 million. Their long-term debt is sitting at just over $100 million. This is up from $68.9 million in June, which indicates they have taken on more debt, certainly something to monitor. Stockholders' equity stands at $271.6 million, a healthy increase from $263.1 million in June. This growth in equity is primarily driven by retained earnings from their improved net income. Next up, the cash flow statement, where we see where the money is coming from and going. For the 6 months ending the 26th of December 2025, the company had net cash provided by operating activities of $12.1 million. This is a significant improvement from a negative cash flow of $6.4 million in the same period last year. This means their core business operations are now generating cash, which is a crucial sign of health. Investing activities show cash used in purchasing property, plant, and equipment was $3.1 million. This is lower than the $7.9 million spent in the prior year, which might indicate a slowdown in capital expenditure, focusing more on operational efficiency, perhaps. Financing activities show they borrowed $50 million under their revolver and repaid $50 million, indicating active use and management of their credit line. They also borrowed $20 million under their term loan and repaid a portion. Overall net cash provided by financing activities was $17.1 million. Their total cash and cash equivalents at the end of the period was $88.6 million, a good increase from $53.4 million last year, showing improved liquidity. A quick look at the notes reveals that Aviat Networks Inc. is indeed a global player. They operate in one reportable business segment, which is the design, manufacturing, and sale of wireless networking products and services. This means all their revenue and expenses come from this core business area. Looking at their regional revenues, North America revenue decreased by about 8.7% for the quarter, but increased by 5.4% for the 6-month period. Africa and the Middle East showed strong growth of 15.4% for the quarter and 18.6% for the 6-month period. Europe also saw a significant increase of 36.9% for the quarter and 36.1% for the 6 months. Latin America and Asia Pacific, however, experienced a decline of 17.1% for the quarter and 3.6% for the 6 months period. This shows a geographical shift in their business, with Europe and Africa Middle East performing exceptionally well, while Asia Pacific is lagging. In terms of specific countries, the United States remains their largest market, contributing about 45.7% of revenue for the quarter and 46.8% for the 6-month period. India is also a significant market, representing about 10.9% of revenue for the 6-month period. It is also interesting to note that a single customer accounted for about 10.7% of their 6-month revenue. While this is not an alarming concentration, it is always good to know that a significant chunk of their business isn't tied to just 1 or 2 clients. Regarding their debt, Aviat Networks has a credit facility that includes a revolving credit line and a term loan. As of the 26th of December 2025, their total debt was around $105 million, with over $100 million classified as long-term debt. They've increased their borrowing capacity recently, which is likely to support their growth initiatives. The interest rates on this debt are variable based on SOFR, or a base rate plus a margin, which is standard practice. Thankfully, they confirmed they are in compliance with all their financial covenants. Aviat completed 2 notable acquisitions. The acquisition of 4RF Limited, a New Zealand-based industrial wireless company, for $18.2 million. They also acquired Nexus Wireless Transport business for about $54.5 million in a cash and stock deal. These acquisitions clearly show their strategy to expand their product portfolio and market reach, strengthening their position in the industrial wireless sector and combining the scale of these entities. The purchase price allocation for these acquisitions has been finalized and goodwill generated is substantial. Looking at commitments, they have outstanding purchase obligations with suppliers of $40.7 million and commercial commitments like letters of credit and bonds totaling $40.3 million. They believe these will not lead to significant financial exposure. They also mention ongoing legal proceedings, particularly an arbitration with NEC demanding additional component purchases, which Aviat believes is unfounded. They are also facing scrutiny in India regarding foreign exchange management on intercompany receivables and payables. While these legal matters are costly, the company does not currently expect them to have a material adverse effect on its financial position. Related party transactions, primarily with NEC Corporation, are significant. They have agreements for manufacturing, supply transition services, distribution, and research and development. For the 6 months ending the 26th of December 2025, they purchased over $7.6 million in inventory from NEC and development services. Their accounts payable to Next were over $35 million. This close relationship post-acquisition is a key part of their operational integration. Now, for my take on Aviat Networks' performance, the company is showing a strong recovery in profitability and cash flow from operations, especially in the 6-month period. This indicates good operational execution after a period of integrating acquisitions and managing costs. The growth in Europe and Africa, Middle East is very promising and offsets some of the weakness seen in Latin America, Asia, Pacific, and a slight dip in North America for the quarter. The R&D spending reduction is a mixed bag. It could mean focused innovation or a pause in aggressive new development, which needs to be monitored. Debt has increased, which is expected given their acquisitions, but it is manageable and they are in compliance with covenants. Their strategy to expand through acquisitions like 4RF and Next seems to be paying off in terms of revenue growth and market position, although the integration costs and ongoing legal matters with NAC require attention. The company appears to be heading in a positive direction with a more robust financial footing than the prior year. Alright, that is our breakdown of Aviat Networks Inc.'s latest filing. What do you think of their performance and their strategic moves? Let me know in the comments below. If you found this analysis valuable, make sure to hit that like button and subscribe for more corporate deep dives delivered straight to you. And don't forget to join our Discord community linked in the description for exclusive content and discussions. Thanks for watching. See you next time.